It's Tuesday, September 1, 2020. Today's episode number 58. Should I invest in L bonds? This is the 39.6 Facebook Live Finance Show, a show that teaches high-income earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, and even the car you drive. Today's question comes from my buddy John, who I went to high school with, right there. Yeah, oh, there it is, and college. He is also now a doctor, and he asked, should I invest in L bonds? Okay, so L bonds, and I have heard of these and similar types of products, but I admittedly had to go do a little bit of research to see what's out there right now. Okay, now, L bonds are bonds that are tied to an insurance product, in particular to life insurance, hence the L. Now, life insurance is a very interesting thing in that there are a lot of ways for people to make money in life insurance. One, you can invest in life insurance yourself or get yourself a policy, get a big policy, and use that to fund a legacy, okay? You can also be on the other side of the coin and be the insurance company and make money in premiums and have insurance policies, okay? So there's money to be made on that side. And then there are third-party people who come in the middle, okay? People who make like commissions. And then there's also like the secondary market where people will sell policies that are already in existence so that that insurance policy does not fail, but some people don't want the policy anymore because they need cash. Now, for example, let's pretend I had a $2 million policy and I'm in hospice and I have months to live and I can't access this $2 million. I recently shopped for a life insurance policy, and they have special clauses now that allow you to draw from that policy so that you can get some cash up front to you when you might need it in your terminal period of life, okay? And this has decreased the amount of reselling of policies. But let's pretend that you couldn't get some money fronted to you from your policy. And I'm in hospice and I have a lot of medical bills, or I did have a lot of medical bills, and I want to pay these off and I don't want to wait for the policy to pay out. Well, I need this $2 million, but let's pretend I don't have any heirs anymore and I just really want the money. I could sell this policy to somebody else and say, hey, I will sell this policy to you for $1 million. Now, I am in hospice, and within 6 months, I am not likely to still be alive, which means then you would get $2 million. So it's a win for me because I get $1 million today, and it's a win for the investor who's going to get $2 million. Now, there are patients who have gone to hospice and then lived for many years. So there's nothing ever guaranteed. But you can see how there's money that can be made. So there are companies that go out there and find people who are willing to sell their life insurance policies. And they may sell them or buy them at not much margin. It could be a $2 million policy and they might buy it for, let's say, $1.5 million or $1.7 million. So that there's not a huge margin, but if the death is certain or likely or very likely, then it could be a reasonable investment. So that's where these companies come in. Now, there is a lot of money that can be made if you can get margins and good spreads on these policies, and then people die, and then the insurance policies pay out, okay? But if you're shopping to do this yourself and trying to buy a policy from somebody else, and it's like a $2 million policy, you might not have $1.5 million to buy it from somebody. So then you need investors' capital to buy this. And that's where these offerings come up, okay? So there's a company called GWG, and they are currently I think, raising capital, and they have a $2 billion offering. Okay, so this isn't something that like individuals go and can front $2 billion. This is a package, $2 billion, and then they are basically syndicating this out, and they are finding investors to put in a minimum of $25,000. It's also sold through broker dealers, through registered investment advisors and whatnot. Okay, so what are the returns on an investment like this? So it's a $25,000 minimum in this current type of offering, and the returns after a 2-year investment is 5.5%. So your money would be illiquid and locked up for a 2-year term, and it would pay out monthly interest for 5.5%. If you did a 3-year term, it would be 6.25%, a 5-year term, 7.5%, and a 7-year term, 8.5%. So that is 8.5% interest over a 7-year term, and that's paid out monthly. That's a very high return, but at the cost of substantial illiquidity, being locked up for 7 years. The plans do renew automatically unless you cancel the auto renewal. So after the 7 years would be up, then it would go another 7 years. And obviously, the longer a term you choose, the higher the rate is, because you're putting your money more at risk. Okay, now on this website on GWG, this is as of June 3, 2020. So you can see there's a huge delta, a huge spread between Treasury bonds, which have a nominal yield of like nearly 0%, and then 5.5 to 8.5%. Okay, now this is illiquid. Okay, you can't get your money out. And I've always said you have to get paid a premium for illiquidity. Otherwise, it's not worth doing something you can't get your hands on. Yesterday, we talked about getting approved for a commercial loan and how you need post-closing liquidity of 10% of the mortgage. Okay, so something like this would not count to that post-closing liquidity because this money's locked up. Okay, it may be considered as part of the net worth, but not in post-closing liquidity. Okay, another disadvantage of this is these bonds are not rated. They are not rated by Moody's or any of those organizations that rate publicly traded bonds. So it's hard to get some sort of a third-party opinion as a retail investor who does not know the space of how likely these are to pay out. Okay. Now, one of the big problems with a package of bonds is that if one of the bonds does not pay out, this can basically throw the entire portfolio to pieces. This is what happened in the mortgage crisis. They packaged these mortgage securities, and if 1% of them failed, maybe 2% of them failed, like the people stopped paying the mortgage and they got foreclosed, it would stay afloat. But once you got to a certain point, like let's say 5% of them foreclosed, then the bond was basically worthless because you can't make it, if you're only offering like 5% yield and you've already lost 5% of the principal, then the best you're going to get is basically getting back to where you started. So people aren't necessarily going to buy bonds that have basically lost all of their value. So the value of them would have to go down in order for the yield to be worth it to the secondary buyer. So that is one of the biggest problems with bonds, is that in a package of bonds, if you only have a certain number of failures, then that number is going to be dependent on the risk of that asset, but the return has to be tied to that risk, and it's hard to know what that risk is without having a rating. Okay. Now, bonds, you have to remember, are taxed as ordinary income. So if you're taxed at the top tax bracket and you're paying 37% federal, then if you're getting a let's say 6% return on interest from these bonds, you would lose nearly 40% of that. So you would lose about 2.5% of that yield. So then you're down to about 3.5%. Okay, so you have to take that into consideration. Now, if you could potentially buy the security inside of a protected account, then that's different. If you could put it inside of a 401k or an IRA, then you could protect yourself from that really high interest tax payment. So, for example, when I do high interest lending, private money lending, I do that from my self-directed IRA. Because if I'm going to rent out or lend out money at 12%, that Roth IRA is going to protect all the interest. I won't have to pay 37% on that. So it's possible a self-directed IRA may allow you to invest in something like this. But because these are not readily just publicly traded on regular or traditional brokerages, you often can't necessarily get them easily in a typical type of investment account. Now, one of the ways that bonds really can make you money is not in the yield. It's in the capital gains. This is actually where a lot of big money goes to bonds, because you can control your risk and you can have a lot of upside and a small, quote unquote, guaranteed yield, okay? And the upside can be in the capital gains. So if you were to buy, let's say, a 30-year treasury bond, a single bond, not a fund, but an actual bond, that treasury bond is going to pay out the return basically guaranteed. Now, it's possible that bond loses, quote unquote, value on the secondary market, but if you never sell it, you will get all your money back at the end, and you will also get the nominal yield, the coupon. If the bond increases in value, you can always sell it and capture that capital gain. So this is why some people really like investing in bonds, because you can have security, but you can also have a lot of upside, especially if you're investing in long-term bonds. Long-term treasuries can be very, 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 very lucrative. I don't know what they've made this year or the last year, but they've done unbelievably well over the past year and a half or so. Okay, I don't think that's an option here. I don't see somewhere here where we can sell this bond on another market and capture capital gains. Okay, now, lastly, high yield bonds in general. So there's corporate bonds that you can see, you can buy on the public market. You can buy these high yield bonds, and you can look at the rating of the bonds that are in there. And the worse the rating, the higher they're going to pay out, because they have to be risk adjusted. Nobody's going to buy a package of poorly rated bonds with a low interest rate, right? It's not worth the risk. Something like this is offering a very high yield, 5.5 to 8.5% in bonds. This is like amazing. However, you don't know what the risk is you're taking to get that. And the upside is limited, but the downside is infinite. Okay, so what I mean by that is, if enough of these bonds fail, it basically becomes worthless. You could lose all of your money, right? But at most, you're going to get that 5.5% return to 8.5% return. So obviously, this is pretty risky, or else they would not offer a return this high. If they were really safe, they would offer a lower return to investors, and they would keep more of the return for themselves. Right? These companies are for-profit companies. Their goals are not to make investors as much money as they can. Their goals are to make money for themselves, and in doing so, make money for investors at a rate that they are satisfied with, where money will come. If the returns are too low, they won't be able to sell anything. Okay? So in general, I avoid high-yield bonds. It's nice and attractive to see that rate look high, but you're taking on a lot of risk without necessarily getting the real upside. It's like equity risk, but not equity potential, right? And so in general, I tend to avoid investments like that, because I like the risk reward to be asymmetrically slanted. Like, if I'm going to take a good amount of risk, I want to have a lot of upside. Okay? And in the end, there's really no free lunch. You can't just get more return without more risk, right? They would never sell bonds at that high of a return if there was not a substantial amount of risk even just liquidity risk, but also just the inherent risk of the investment baked in. So it's something very interesting. And I'm really not opposed to the idea of investing in life insurance like this, because there's obviously a lot of money that can be made when life insurance policies can be gigantic, right? And there's definitely money to be made here. It's a relatively newer space. This company's been around for a while, but there's not a lot of companies out there that do this. There aren't really publicly traded versions that I know of. There's probably some. One of the big companies that specializes in alternative assets is AQR. They have a lot of different alternative investment funds that are publicly available. However, they actually were in this space, but I looked them up, and it looks like a few years ago they shut down their arm in reinsurance. Okay, so reinsurance is basically investing money for insurance companies, because insurance companies make money, but they need money in to buy to. So it's basically investing in insurance, similar to what this is. So I think that's all I have for this topic. It's a really interesting topic, and it's something that will probably grow in the future, because people are looking for more assets that are not directly related to the publicly traded equity market and bond market. And life insurance has really nothing to do with the economy per se. It's so separated, because people will die, and maybe there's some association with the economy, but people are going to die regardless, and that correlation is going to be relatively small in comparison to other things that are much higher correlated to the publicly traded market. All right, that's what we have for today. I'm heading out of town. That's why I did this broadcast early today. I will plan to do another broadcast tomorrow, assuming we have internet somewhere in the middle of nowhere. And I do not have a sat phone. I am not that awesome. All right, this is brought to you by the Medicine, Marriage, and Money podcast, coming to you, launch date September 14, 2020, only 13 days away. So hopefully this week we can get all these podcasts edited and boom, ready to pop. This is, again, not financial advice, not legal advice, not any sort of advice. Strictly entertainment for me, maybe for you as well. Until tomorrow, have a good one.